So basically the fundamentals to accounting, or at least for the balance sheet, which makes up basically the entirety of what we do, comes in 3 accounts, which are assets, liabilities, and equity. The basic accounting equation is assets equals liabilities plus owner's equity. Essentially, if you add up both the equity and the liabilities, it should equal the assets account, which is why it is a balanced sheet. It's a very simple way to remember that. There are many different accounts. The most basic ones for assets would be cash, accounts receivable, and inventory. Assets are basically things that you own. Now when you get into liabilities, they are things that you owe. For instance, accounts payable, notes payable, and unearned revenue. And when you get to owner's equity, or sometimes known as shareholders' equity, stockholders' equity, however you prefer it, is typically stock, common stock, preferred stock, or retained earnings. Now, the things that make these accounts different is assets are debit accounts and liabilities and owner's equity are credit accounts. More specifically, what makes one a debit or credit account is if it gets debited, the account would go up, and if it's a credit account and it gets credited, the account will go up. We'll get more into that later.
Thank you for your time. Welcome back to talk about the income statement. The income statement is pretty straightforward, so if you don't understand it by the end of this, you should probably not be an accountant. It's made up of revenues and expenses with the ultimate goal to find the net income. What you do is you take the revenues, which are they're pretty straightforward. They're your sales, your service fees, interest income, the like. You subtract out your expenses, which are dollars expended in the everyday operations of the business. And those will be like your depreciation expense, rent expense, stuff like that. Stuff that the company spends every day. And the final result will be, as shown here, the net income, which is how much money the company ultimately makes. As he is writing on the board, revenues are credit accounts, meaning that they're increased when you credit them, and expenses are debit accounts, meaning that they're increased when you debit them, allowing them to offset. The end.
All right, now we're going to look back into the balance sheet and talk about how the income statement affects the balance sheet. For the most part, the balance sheet is a snapshot in time, and the income statement is over a period of time. And a better way to explain that is the income statement gets closed out at the end of the year. So at the beginning every year, each account is zeroed out. Or at the end of the year, they're zeroed out, so at the beginning, they're at 0.
For a fresh start.
Yeah, and the balance sheet is permanent. Those stay open all year, every year, which is why when you're looking at it, it's just for that specific day. And when you're looking at the income statement, it's looking at the fiscal year.
In summary of what he just said, the balance sheet accounts will be a running total of those accounts and not just the year's worth, unless of course it's the first year of operations.
Exactly. So basically we have our accounting equation we talked about earlier, A equals L plus E. And then we have the income statement and how we found net income. Now we're going to find retained earnings, which is an equity account. And to do that, you're going to take the beginning retained earnings from the previous year, if you had a previous year. And then you're going to take the net income that you found in the income statement and add it into that. Then you're going to subtract out dividends, which is something we'll briefly talk about later. And then after doing all of this, you're going to get ending retained earnings, which goes into the equity accounts, which again is a normal credit balance. If it's positive, and if it's negative, it's going to have a debit balance.
So this will explain the relationship between the income statement and how it affects the balance sheet. And as he mentioned, dividends are portions of the company's revenue that is returned to its shareholders, if it's a public company, or returned to its owners. If there's only one owner, it's a private company, it'll be returned to the owners in one way or another. Thank you for your time. Alright, youngsters, let's review the knowledge we just dropped on you. Starting with the balance sheet. The balance sheet is made up of assets, liabilities, and owner's equity. The basic accounting equation is assets equal liabilities plus owner's equity. As you remember, the asset is a regular debit balance, liabilities and owner's equities are regular credit balances.
For the income statement, we have the basic equation for revenue minus expenses equals net income. If you remember revenue is a credit balance and expenses is a debit balance. The same thing goes, we have all of these represented with T accounts. For the most part, debits are on the left, credits are on the right. That's just generally how you do transactions, and to get things to balance, we have credit on one side, debit on another for two different accounts, which we'll get into later with a few examples. For net income, it's a little bit different because it could represent two different things. You could either have a profit, which would be a credit balance, and a loss would be a debit balance. And if you think about it, it makes sense because owner's equity is a credit balance, would make it go up. If you have a profit, it would be a credit balance, so that this would affect this in a positive way, and if it was a loss, it would affect it in a negative way. Now to go on a little more with the trial balances and the T accounts, we're going to do a couple examples with journal entries.
And you're going to love them.
Cash investment of $100,000 is made by owner Faith on 1/1/2015 to start the firm Daney Co.
Number 1. For this transaction, the owner of the company invested $100,000 of their own money to go into owner's equity. This transaction can be shown by debiting cash for $100,000 and simultaneously crediting owner's equity for the same amount. As you can see, the debit entry will be slightly indented compared to the credit entry to denote that they are in different columns.
On 1/2/2015, Daney Co. made a cash payment of $20,000 for 6 months' rent. In this example, first we take prepaid expense as a debit for $20,000. Then because we want to decrease cash, we credit it for the same amount. On 1/3/2015, Daney Co. paid cash for new equipment at a cost of $4,000.
Can I just laugh and do it?
Sure. You do you, man.
So for transaction number 3, we bought equipment. So we're going to debit equipment for $4,000 and credit cash for the same amount. This increases our asset for equipment and decreases cash.
On 1/4/2015, Daney Co. received inventory that had not been yet paid for in the amount of $6,000.
For the 4th entry, we've received inventory that we purchased on account. For this entry, we will debit inventory for $6,000. We will credit accounts payable, which is a liability account, for the same $6,000. Again, the inventory is a debit and the accounts payable is a credit, meaning the accounts payable entry will be indented more than the debited entry.
On 1/5/2015, Daney Co. sold inventory costing $4,000 for $10,000 cash. For the first half of this transaction, we will debit cost of goods sold, abbreviated as COGS, $4,000. And we will credit inventory for the same $4,000. For the second half of this transaction, we will debit cash for $10,000 and credit revenue for the same $10,000. On 1/6/2015, Daney Co. sold the remainder of their inventory for $5,000 to be paid later.